Thanks so much for joining us here on a Tuesday. I'm Marlon Bowling with you with a look at your grain trade. Let's focus on our prices in Chicago right now. We'll start out by looking at this corn market, which has really been kind of weak in the knees here all morning long. And it started out that way actually overnight after we got the crop condition numbers from USDA yesterday afternoon. And we've seen follow-through selling here this morning. Overnight, it was roughly about 4 cents lower. Right now, we have September corn down about 6.5 cents. We are trading at $347.5 per bushel. And now you have that December new crop contract on the corn at $360.25. That would be down 6 3/4 cents on the day. And let's take a look at our soybean trade for you. On the soybean market, we have the August contract 3 higher at $858 3/4. And we have the November new crop soybeans coming in there at $874 3/4. That would be up 2 3/4 cents on the day. So they are higher, but they are off of their earlier highs by roughly about 6 cents right now. Let's switch over to the wheat. Now, the wheat is seeing a lot of pressure here today. And in Chicago wheat, we have September currently down 15.5. We're trading at $492.5, and we have December down 14 1/4 cents. Meanwhile, let's take a look at the Kansas City wheat market. And on the Kansas City trade, we have the September currently down 13 1/4. We're trading at $492 3/4. Meanwhile, we have the Minneapolis wheat on that September contract going down by 8 1/4 cents at $5.39 on the day, $5.39 3/4 per bushel. A cotton trade right now has the December new crop contract 37 points higher at 85.84 cents per pound. We're going to talk with Brian Hoops of Midwest Market Solutions and get his thoughts on today's market activity. And Brian, so glad you could join us here today. Your thoughts on this kind of divergent market, I call it here, between the corn, soybeans, and wheat today, kind of going all directions here.
Yeah, it really is. You know, the downside's been led by the winter wheat contracts. There's some additional rain in the forecast for parts of Russia where it's been very dry. And the trade had been anticipating that with dry conditions in the Black Sea region with Russia, their crop would be downsized. We would get some export business, but that may not be the case with the rain stabilizing this crop. In addition, Egypt's buying some wheat this morning. Looks like it's going to come from Russia. So once again, we're shut out of the export market. We're too highly priced compared to other world countries. And that's why we're seeing such a big drop in the winter wheat contracts. That Minneapolis contract falling on better than expected crop condition ratings. A 3% jump is a big number for 1 week, and it puts us at near all-time highs for that spring wheat crop. So it does look like we're going to have a much better crop than last year. Canada's going to have a good crop. It's pulling corn along with it. Plus, we're looking at Thursday's supply and demand numbers and anticipating a little bit of a bearish report for corn, soybeans, and wheat as USDA will incorporate new planted acreage numbers that we got on the acreage report, as well as the beginning stocks, which were all larger than expected, and that'll give us bigger carry-in numbers as well.
And we do have to keep in mind that this morning there was an announcement of 113,000 tons of corn sold to Egypt overnight, but Mexico canceled 152,000 tons of sorghum, so they kind of offset each other. Brian, we'll bring each other back here in just a moment. We'll take a look at what's going on in our livestock trade as well. Get your thoughts on that. Some big movement going on there. Took out some support levels, and we'll talk about it when we come back. Let's bring back Brian Hoops of Midwest Market Solutions, and he is based in Springfield, Missouri. I want to take a look at what's going on in our livestock trade here, Brian. First of all, we'll go ahead and take a look at the live cattle board in Chicago and see what the current prices are. We do have a weaker tone here, not like what we have seen in the lean hog trade, though. We are lower across the board. August live cattle currently down 72. We're at 105.40 per hundredweight. So that's down about $1.25 off of its earlier high. It had quite a reversal after the open. October down 84 at 107.78. And December down 80 cents. Now, on the feeder cattle side of things, we have the nearby August contract on the feeders, also trading a little weaker. We're down 20 cents at 151.25. September down 23 at 151.55. All the news so far this morning on the livestock sector seems to be focused on the lean hog trade and the fact that there has been tons of support taken out on the lean hog market on the bottom side, at least in the August contract. From my calculations here, Brian, the pins of support on contract lows were obliterated this morning right after the open. So we have the August all the way down to 70.50 now. The contract low, I believe, was at 72.45. So almost $2 under the previous contract low. We're down $2.28 right now. October, though, only 44 lower at 55.68. So obviously, it seems like there's some very large spread trading going on here in this lean hog trade.
Yeah, that's what's going on, and we're seeing contract lows almost exclusively across the board. It's really going to be an interesting market here because right now the futures job is to anticipate where that cash is going to be. And, of course, we're expected to see much more hog supplies coming to market over the next several weeks and several months into the third and fourth quarters, and that's why we're falling to these contract low levels. But the lean hog index, which is a measure of where the cash markets are, at about 82 cents. July goes off the board later this week, and it's trading below $80. So either the index has to fall lower or the futures have to start to rally. And now you have August hogs at around $70. So you're holding about a $12 discount. So the market's really anticipating the cash markets to free fall over the next several weeks. And there's very little producers can do to protect themselves other than get things marketed with a packer at a better price level. But that may not be the case with these futures markets. So hopefully futures are taking this anticipation too far, too fast, and that the cash won't fall this much and that they'll start to snap and rebound back as we get into the late July and August delivery time frame of those cash markets.
Well, that was my next question. Obviously, we gleaned quite a few sell stops below that contract low this morning, and they really accelerated it to the downside. What do you think the odds are that they will pretty well clean house, I guess they would say, today and kind of erase that slate?
Yeah, it's a good way to put it. You know, they may be cleaning house in here from the standpoint of running a lot of stops that were underneath the market, and hopefully that is the case. As we don't want to see this downward pressure come into play here. But the USDA is predicting much larger slaughter numbers and much numbers coming through the pipelines in that third and fourth quarter. So it is important for producers, if we get a snapback rally, to go ahead and make some hedges, make some sales, as our supply may just overwhelm all the demand that we have built up.
All right. Well, thank you, Brian, for talking with our audience today. Brian Hoops of Midwest Market Solutions. He is based in Springfield, Missouri.